Well, we've been tracking the financial results from the big Canadian banks this week, and so have our Bloomberg colleagues. And they pulled out some interesting mortgage data. It shows more and more Canadians are extending the amortization periods for their mortgages. Just as one example, the country's largest lender, RBC, says as of July, 43% of its residential mortgages had an amortization period of longer than 25 years. 25 years being the sort of typical length. Now, that is up from 26% at the start of last year. So quite a difference there. While the proportion of mortgages that are amortized even longer for more than 35 years, that's also growing. It's now making up 23% of RBC's mortgage portfolio. So is stretching out your amortization a good strategy in the short term? For more, we're joined by Sean Humphries, a mortgage broker with Dominion Lending Centers. Sean, thanks so much for coming in.
Thanks for having me.
So is this something that you're seeing more and more people choose to do as well when it comes to either getting a new mortgage or renewing a mortgage to try to make things, bite a little less?
Sure. I mean, it's all about cash flow, right? Like, as people are getting into these higher priced homes and the cost of the interest is going up, kind of an easy strategy is to stretch out the amortization to manage that cash flow. Whether it's the cost of bread going up or everything else going up, just being able to control one of those costs is very key for people going forward.
Before, a year ago, 25 years, that would be the typical, right?
Yeah, I mean, an insured mortgage, if you're purchasing with less than 20% down, less than $1 million, the maximum you can go is 25 years. So, I mean, typically that's been the maximum purchase price because not a lot of other properties have been over $1 million. Now, the average price here in Toronto is well over $1 million. So having longer amortizations is just par for the course with the higher purchase prices.
The people that you're seeing recently that are wanting a mortgage, whether, like I said, it's a new one or one that they're renewing, what is the stress level like right now? What are you feeling?
I think everybody's feeling the stress of just higher interest rates and how that's going to affect them. Certainly, it's not doubling their payments necessarily, but it's causing that unknown of what will my interest rate be like in 3 months from now or in a year from now. People just are unaware of what that cost will be, and I think that's what's causing the stress.
When we were looking at the bank results, we were also seeing, we've got a chart on this, not this one, but another one, that shows mortgage growth slowing. When it comes to the people who are coming to you, are you seeing fewer people getting a new mortgage these days, buying a house these days?
Well, I think we had a big run earlier in the year when the Bank of Canada basically said, we're not going to be increasing interest rates. And basically, it was the dinner bell for getting mortgages again. People thought, OK, well, they're not going to be raising the rates. It created some certainty, and that's what caused people to go out and buy more homes. So we're seeing a lot of those mortgages close now, or people who had rate holds, they're getting their mortgages now. But I think into the future, we're going to be seeing much less. And I mean, it depends on what the bank says September 7th, and maybe the doors will be open again. But it sounds like that's not going to be the case.
Yeah, when it comes to getting that rate hold, how does that work? How long can it be for, when you're, if maybe you know that you need to renew your mortgage in a few months or a year, how far in advance can somebody, get in touch with a mortgage broker and line something up so that they know that they at least have their hands on something?
Right. Well, we can hold rates for 120 days, but I think it makes sense if you're thinking about it and you're wondering where it's going to be to get in touch with a mortgage broker as soon as possible. I mean, there are strategies where you might want to break it more than a year out, especially as interest rates are going up. That can be a strategy, especially if you can lock into something short term and where you can minimize the payment. But it's 120 days to hold the rate, and then you can look at your different strategies from there.
If there happened to be a better rate during that time, but before you actually got the mortgage, then you'd be able to get that better rate.
Yeah, you're not committed to that. You can lock in a rate at 120 days, and if rates happen to go down, which they haven't done very much lately, but if they do happen to go down, then you can get a better interest rate at that time. You're not committed to it.
In terms of the actual mortgage term, so not the amortization, but just, the number of years that you're going to be paying at that rate. So, it could be between 1 and 5, right, would be the range in Canada.
You can go 7 and 10
You
years
go 7 and 10 even,
yeah.
okay. But would that be quite a premium if you were paying for the 7 or 10?
Well, the 7 and 10, like it's unlikely you would take that. I mean, it might be lower now because the longer term rates are lower than the longer term rates, but not a lot of people are choosing that, especially as interest rates are at 6%. Nobody's thinking, hey, it's a great idea to lock in at this rate for 10 years.
Yeah, so. No, that would probably seem silly. What are people choosing to do? How short term are you seeing people go?
It's a lot of people are choosing the 2 or the 3 year term. The 5-year rate has the lowest interest rate right now. So if you are looking at maximizing your purchase price, you're probably sticking to the 5-year rate. If you're renewing and you think, I think rates are going to come down and I'm uncomfortable with variable rate, then you might choose something in the 2 or 3 year term. But then you're paying a premium on what you would pay for a 5-year. And you're hoping that interest rates drop dramatically over the next 2 or 3 years.
I'm also curious just about the, insured mortgages when, you don't have 20% to put down. You are paying that insurance, but those rates are lower than the uninsured mortgages, aren't they?
Yeah, so the rates are lower, and that's often what I get. Oh, if I put down a bigger down payment, shouldn't my rate be lower? But the thing is that it's an insured mortgage. You're paying for insurance, and so it makes it less risky for the lender or the bank in order to lend it, and so they can do it at a lower rate. If you put 20% down and you've got 25-year amortization and purchases under $1 million, you're not purchasing the insurance, but the bank is purchasing the insurance in that circumstance, and that's what pushes the rate a little bit higher.